All right, let's get the party started. Hi, good evening, everyone. Thank you all again for joining us this evening or in the afternoon if you are tuning in from the Middle East. I know we have a lot of people from different parts of the world right now. So wherever you are, welcome and thank you for joining us. Really quickly, my name is Amanda and I'm the country manager of StashAway in Singapore. So today's topic is on a deep dive into China and Chinese tech. So as you guys can imagine, over the past couple of weeks, I think it has been all over the news on the Chinese tech crackdown, and I think a lot of people have a lot of questions about that. So we're gonna obviously try and address as many of those questions as possible this evening. And for us to do so, if you have any questions, please feel free to post it in the Q&A box that you see at the bottom of your screen. So we're gonna have a live Q&A session towards the end. Where I will pick and choose and try and moderate as many of those questions as possible and pose it to both our panelists today. All right. So the agenda is that we're going to begin with a presentation by Brendan and then followed by Freddie, and then we'll move on to the Q&A. All right. And let me quickly introduce our panelists as well. I have with us Brendan Ahern. He is the Chief Investment Officer of KraneShares. And I also have with us Freddie Lim, who is the Chief Investment Officer and co-founder of StashAway. Thank you both for joining us this evening. So what I'm going to do now is I think, we have all of the administrative matters out of the way. I'm going to hand it over to Brendan. We have a very power-packed agenda, so I want to make sure that we have enough time to get through all of it. So I'm going to stop sharing my screen now, Brendan, and you should be able to share your screen and present.
Thank you very much, Amanda, and likewise, Freddie. Very much appreciate this opportunity, and let's dive right into it. So let's again. My name is Brendan Ahern. I'm the Chief Investment Officer of KraneShares. We're a U.S.-based ETF manager with a focus on China. We're very much focused on the growth segments of China. We were founded in 2013. Our founder, Jonathan Crane, lived in Shanghai in the early 2000s, where he built a successful business geared to China's growing urban middle class. Living in Shanghai, Jonathan experienced how China was moving away from traditional old economic drivers to new China thematics, things such as China internet, healthcare, 5G, semiconductor, clean energy, as well as it was the opening of China. That beginning in the early 2000s, China started allowing foreign investors investing in the A-share market, the Shanghai and Shenzhen market for the first time. And ultimately, Jonathan's experience living in Shanghai after he sold his business led him to founding KraneShares in 2012. I joined Jonathan. I had worked for Barclays Global Investors during the rollout of the iShares family of exchange-traded funds. I then worked for BlackRock after they bought iShares and Barclays Global Investors. And really, my job was making Jonathan's vision investable. So really what I did was I built our suite of exchange-traded funds, including KWEB. So I actually built the KWEB index, which is maintained by CSI, China Securities Index Company. But I think our most important thing that we do at KraneShares is providing a balanced perspective on what's happening in China today, both the economy as well as capital markets. And I believe that this mission of ours has never been more important than today, that a lot of what we see and read in the media is not necessarily data driven. And in finance, everything we do is data driven. And we try to bring that perspective to our investors, and I very much appreciate this opportunity today. So let's dive right into what's been happening with KWEB. Ultimately, we've had everything but the proverbial kitchen sink thrown at the China internet space. It really kicked off after China's New Year in mid-February, where we had a correction, and that correction very quickly became a bear market. Now, what started in mid-February was we discovered that there was a hedge fund called Archegos. Archegos was a US-based hedge fund that was highly leveraged. They were borrowing money from investment banks in order to invest in 10 securities. 5 of those 10 securities were US listed Chinese companies. And when one of its 10 holdings had a significant downdraft, they basically were forced out of all of its position, that the investment banks that they had borrowed money from ultimately seized their assets and liquidated their securities at very significant discounts. Now, I think what's important is that when you look at the KWEB's position over the last 2 years, if you look at a chart of KWEB, it was experiencing a slow and steady rise. And all of a sudden, in mid-January through mid-February, that slow rise went straight up. And I believe that was Archegos putting its trades on in those 5 securities. Now why is, we hold dozens of stocks. Why is the liquidation of 5 securities so important? Well, it's very simply that investors in this space value the companies based on what the other company's valuation is. And when those stocks were sold at discounts of upwards of 50%, it weighed on the space. Now that's not the only issue taking place. Another factor is that in December, the U.S. signed a law called the Holding Foreign Companies Accountable Act. Now, that law says that U.S. listed Chinese companies need to adhere to an audit standard that is globally recognized, that in order to be listed in the United States, companies have to allow the PCAOB, the Public Company Oversight Accounting Board, to review their audits. And Chinese law has historically not allowed those auditors to provide their audit papers to the PCAOB. Now, this issue has been out there for 8 years, but it's really dragged on, and the Luckin Coffee fraud really exacerbated this issue of why are these Chinese companies not adhering to this global standard? And US politicians said, we're going to force this issue to be addressed by saying, if these US listed Chinese companies don't allow this audit review, they'll be delisted. Now, on this issue, it's something that we monitor very, very closely here at KraneShares. Is the important thing to recognize is that the auditors of US listed Chinese companies are the big 4 US accounting firms. Those same accounting firms do the audits of US companies' China business operations. So a lot of publicly traded companies in the US have the exact same auditors as the auditors in KWEB. The problem is that the auditors' review is not allowed to be examined by the PCAOB. Now, it's important to recognize that we don't know exactly when the SEC will start this 3-year clock. We monitor this very, very closely, that the SEC current chairman, Gary Gensler, was a very strict regulator when he was with the CFTC. At the same time, these companies were allowed to list in the United States. And to change the rules is a little unfair to them. Additionally, this act, because it's been politicalized, the view was that this is a way to hurt China, but it doesn't hurt China in any fashion. It hurts US investors. And I think what's important to recognize is that currently 60% of KWEB is invested in US securities. Half of that is we're able to convert from the US share class into the Hong Kong share class. Conversion of the US position into the Hong Kong listing is done very easily. You simply tell your custodian at the end of the day that you want to convert your US ADR into the Hong Kong share class, and tomorrow, the next day, you own the Hong Kong share class. So within KWEB, we have the ability to convert more than half of our US ADRs into the Hong Kong share class. We also have the Hong Kong Stock Exchange is in the process of changing their rules, their listing requirements to allow all of the US companies to convert. So as a shareholder myself in KWEB, we will not stand idle and watch our holdings be delisted. We will simply convert out of the US names into the Hong Kong names. That begs the question, why haven't we converted? Well, we've not converted thus far because the US share classes have significantly higher volumes. The value traded of Hong Kong share classes is much higher than the US. The US share classes are much higher than the Hong Kong from a value traded. There's just simply a higher cost to transact in Hong Kong today versus the US. Hong Kong has a stamp tax, but it's something that we monitor on a daily basis. And if we see that the Holding Foreign Companies Accountable Act will be strictly enforced, we will simply convert out of the US names into the Hong Kong share classes. Again, I am personally an investor in KWEB. As a fiduciary, I have a responsibility to protect your assets, and I will not stand idle and watch our holdings be delisted. We will act in your best interest. So on the Holding Foreign Companies Accountable Act, again, it's something that we monitor very, very closely. Our risk committee meets on a weekly basis. We have been in contact with our index provider to inform them about the Holding Foreign Companies Accountable Act. It is an issue that I take very, very seriously. Now, another factor has been the China regulation of internet companies, that 30% of all retail sales in China today flows through the companies that we hold in KWEB. And we believe that regulation is not necessarily a bad thing. That if you think about US companies like Google or Amazon, who regulates them? The end reality is nobody does. And in Europe, back in 2018, we had something called the GDPR, the General Data Protection Rights, simply said that when you download an app, that app is accessing literally everything you do on your phone. And Europe passed this law to say that user data, user privacy rules need to be protected. And an element of what China is doing is simply enacting a very similar rule. Now, there is another factor. We'll talk about the China regulation. Is US-China political relationships are very, very poor at the moment. This is the Goldman Sachs US-China relationship barometer. And this very high level is a bad thing, that it shows that the political discourse between the US and China today is very poor. Now, what's interesting when you look into this Goldman Sachs barometer of US-China relationship, you can see that the political relationship is very poor at the moment. But again, it's almost like an inverse. At the same time, US and China economically have never been better from an economic relationship perspective. That China, as the second largest economy in the world, is a very significant trade partner with the United States. We recently had the July import data, And it's interesting to note that China's imports from the United States increased over 30% year over year in the month of July. So that's very similar to what we've seen to China and Taiwan, where imports increased over 20%. China's imports from Australia went up over 40%. To Europe, and it increased very significantly. So for whatever reasons, politicians can't get along very well, but the business people seem to be getting along just fine. And so ultimately, the US and China have never been more intertwined economically than today. And in fact, US listed stocks generate almost $400 billion worth of revenues in China today. Many would be surprised that Texas, the state of Texas, recently overtook California as the largest exporting state to China. And that's really driven by oil and liquefied natural gas. But if you think about politicians, you wouldn't believe that. That obviously some of the China hawks politically come from the state of Texas, and yet the state of Texas is doing great business with China. So we think that ultimately there's been a lot of bark when it comes to political discourse around China today, and yet there's been very little economic bite. That many of the headlines we read really don't hurt China. We saw this under the Trump administration, where he called himself the tariff man, and yet the tariffs didn't hurt China. It hurt US importers. China doesn't write the tariff, doesn't write a check to pay the tariffs. US importers do. It hurt US consumers. That what we pay in stores today is simply larger because of the tariffs. It's something that was a great headline of how we were hurt, how the U.S. was hurting China, but it didn't hurt China. It hurt U.S. consumers. So we'll talk a little bit about what you as an investor should watch. Now, on the regulation, markets always hate uncertainty. And the regulation of the companies within KWEB creates a vast amount of uncertainty, that we don't know what the end game is. The other issue around regulation in China is that it is multifaceted, and there's been very little transparency on what is the end game. And yet we've seen time and time again, the companies adhere and adopt to regulation without being hurt from a fundamental basis. Now, there are two instances where the regulation has hurt companies. The first would be after-school tutoring. And within after-school tutoring, there's really two companies. There is a company called New Orient. The US ticker is EDU, and the other one is TAL Education. Those companies have fallen very significantly due to the rules around after-school tutoring. Now, we've never held EDU in KWEB, but we have held TAL. And TAL has hurt a KWEB. The position today is very small, under 1%. And obviously the situation with TAL is very disconcerting. At the same time, I do understand why China did this. That a few months ago, China had its latest census, its latest 10-year census. That census stated factually that China's birth rate is down to 1.3 children per woman in China. Now, China has a significant Gen Z population. Almost 400 million people are under the age of 30. But what the census tells us is that in several decades, China has a demographic issue, and China needs to raise that birth rate. And one of the things that's been discovered is that, as reported in mainland media in China, is that 25% of urban income goes to after-school tutoring. And so one of the things that's keeping parents from having more children in China today is the amount that has to be dedicated to after-school tutoring. So by bringing after-school tutoring under the realm of public schools as opposed to for-profit companies, it relieves a significant burden on families in China today. Now that's been a very big problem, not only for public equities like TAL Education, but the significant amount of private equity in this space. At the same time, I do understand why they did this. It's also why investors, we caution that real estate is a big problem, that China has very high apartment prices. And if I'm a parent and I can't afford a 3 or 4 bedroom apartment, it's an area that we as investors need to be very cautious to. So real estate, we do recommend investors be aware that it's apt to fall under regulatory purview. Another issue is that China is highly urbanized. 60% of the population lives in cities. They don't have traditional houses. So I live outside of New York City, and I live in a 5-bedroom house. And so I have 3 children. So they each have their own bedroom. China needs to develop suburbs like we have here in the United States. You need to have houses so people can have bigger families. So we're cautious about real estate. And at the same time, it might not necessarily be a bad thing for real estate developers, because we believe China needs to develop traditional houses like we have here in the United States and in the West. Now, the other issue, the other company that will be hurt by China regulation is Didi. That Didi went public in the United States, and whether or not they knew that they were going to be regulated is up for debate. But Didi pushed ahead with its IPO, knowing explicitly or implicitly, knowing that it might fall under regulation. And that's exactly why China stopped Ant's IPO. That they simply said to Ant, you're about to be regulated, but your IPO prospectus says that you have all this financial data pre-regulation, and that financial data might be affected. So they stopped its Hong Kong IPO. We do not hold Didi in KWEB. Didi will face a very significant fine, but we don't hold Didi. But it's an issue you should be aware of. Now, the reason that we're seeing the price action in KWEB up until very recently be as poor as it has been is markets hate uncertainty. And you can see that the regulation of the companies within KWEB is multifaceted. You have antitrust, which is really anti-competitive. The companies in KWEB hate one another, and they've done everything they can to hurt one another. At the same time, these companies have adhered and adopted to the regulation. Fintech regulation affects companies like Tencent, that has a very significant fintech arm, and they've simply adhered to the regulation. You have data security, privacy. Where's the data held? How is it protected? So markets hate uncertainty, and not knowing the end game of regulation has weighed. That investors hate uncertainty, and the ad hoc nature of the implementation of this regulation has weighed on it significantly. Now, that is what's important, is that we're starting to see that we're getting more transparency on the regulation, that the Ministry of Industry and Information Technology a few weeks ago said, we're going to do a 6-month review. And 68 companies, including the vast majority of companies within KWEB, have adhered to this regulation. So we're starting to see that it's recognized in China that it's not the regulation, it's how it's been implemented, the uncertainty, the lack of knowing the end game. And we're getting increasing amounts of transparency on what is the end game. that we've seen that a user data and user protection laws will go into effect in September and November. So we're getting more transparency. And that is something that will bring investors back into the space. Now, we've seen regulation in China occur. Several years ago, we had the healthcare sector, a very important sector in China, come under regulatory purview, that they implemented a national procurement process of buying generic drugs at the national level. Now, the uncertainty about this regulation at the time, you can see really weighed on the sector, that investors, again, they hate uncertainty. The lack of knowing what this regulation was going to involve weighed on the sector. Now, over time, we got higher and higher levels of transparency, and that led to the market coming back very significantly. And we don't believe that this time is different. We believe that, like we saw in regulation, that in the healthcare sector, that as we got more transparency, the sector rebounded, but in the short term, it was very painful. Now, it's very important to recognize that I had mentioned that the companies are adhering and adopting to the regulation. And we've seen this in the Q4 earnings. The Q4 earnings for the KWEB companies was in February and March of this year. We highlight, this was what Tencent, their CEO, the president, Martin Lau, said at the time. He said simply, we're adhering and adopting to fintech regulation. It's no problem. We hold 30% of the loans. We don't lend to college students anymore. We only lend a maximum of 200,000 RMB. It didn't affect the Q4 earnings. And we saw this again in the Q1 earnings reported in May. And right now we're going through Q2 earnings. Just this morning, we had Pinduoduo just reported its Q2 earnings. Revenues grew 89% year over year. This is the Q1 earnings that we got in May. The importance here is that the companies are adhering and adopting to the regulation. Their business models are not going away. They're simply adhering and adopting to the regulation, and look at the results. Now, more recently, we're starting to get the Q2 earnings. I mentioned PDD reported earnings this morning. They grew revenue 89%. The company reported a net income gain, an earnings per share gain, which was not expected. The company went from generating losses to a profit. But yesterday, we had JD.com reported earnings. Revenue growth increased 26%. Bilibili online video Q2 earnings revenue growth 71%. VipShop, an e-commerce company, 22%. Tencent reported revenue growth of over 20%. Baidu reported revenue growth of over 20% in Q2. Alibaba reported revenue of almost 34%. The companies are adhering and adopting to the regulation without being hurt. But I know you're saying, but Brendan, I look at the price action, what's happening? It's the uncertainty. Investors hate uncertainty. Now that's led to KWEB, that the fundamentals, we're looking at price to earnings. We're at a very low level of valuation in KWEB, that we can see that we're at a PE of less than 17 versus a historical average of 27. The forward-looking PE is very, very low. Now, compared to US internet companies, we're now at a PEG ratio. So that's the PE ratio divided by the growth rate. The PEG ratio is well below its historical average. On a relative basis, compared to US internet companies, they're at a PEG ratio of 2.5. We're at 0.8. This disparity is simply massive. Again, and now what's happening? Well, part of what's happened, this uncertainty, is that many active mutual funds have simply left the space. That they've simply said, because of this uncertainty, I'm simply going to get out of the China internet space. And we saw this starting in Q2. Now, why is Q2 important for US mutual funds? It's because they have to show their holdings. And so they simply said, we're going to get out of the China internet space. Now, why is this important? Is this vast underinvestment in the KWEB companies today means that these investors are going to have to come back into the space. And that dry powder coming into the space is going to eventually rise these companies. I do believe that. Overnight, a well-regarded hedge fund called Causeway Capital, their CIO said that she is buying these names. We had overnight, Kathy Wood of ARK Investments said that she is buying these names. Ray Dalio from Bridgewater wrote a note several weeks ago saying that they like the China internet space. So all of this dry powder is going to come back into these names. And I think that's going to get KWEB up. I wish I could tell you exactly when that was going to happen. I can't. I don't have a crystal ball. But I do know there's a lot of investors will come back into this space. And I think there's evidence that that's happening right now. Now, unfortunately, over the 8-year history of KWEB, we listed KWEB on August 1st of 2013. Unfortunately, we've had significant downdrafts in KWEB. Those downdrafts have historically been followed by significant increases in price. I certainly hope, as an investor in KWEB personally, that we get this same rebound. There's evidence that this is happening as we speak, as we gain more transparency, as we get investors saying that they're coming back into the space, that we're apt to get a significant rebound. I wish I could say that was definitively going to happen. But I think the important thing to recognize is the core thesis of KWEB has never been better. And again, this price action in KWEB as an investor has been very disappointing. But I think it's important to recognize that the companies are performing fundamentally well. I talked about some of the Q2 earnings that we've gotten. Oh, sorry, I think, give me 1 second. I apologize. I don't know if you could hear that background. I was listening to Pinduoduo's earnings call prior to our conversation today. Apologies for that. That e-commerce in China is significant today. China's GDP, 50% of the revenue of China's 50% of China's GDP comes from the service sector. And that comes from the KWEB companies, right? That we see that China, they need to raise domestic consumption. And that is why the KWEB companies are so important to China's economy. Should they be regulated and supervised? 100% they should be. At the same time, these companies are important to China. There's another factor at stake, that from the earnings calls that we've had, Tencent's earnings call, it's very important that they said how important that they are to small companies in China, that they provide a lot of loans. Baidu recently held its Baidu World event, where they highlighted how Baidu is so important to China's new economy due to its efforts in cloud computing, big data, and electric vehicles. Baidu is an important company for China's new economy. Now, one of the factors that's weighing on China is the media. That the media today, every day I wake up, I read the Wall Street Journal, Financial Times, and I say, oh my gosh, like, you know, this news is so bad. But the reality is that China's China's economy is doing well, and that's good for the KWEB companies, that they are the transmission engines for domestic consumption. One of the things that I always watch when I see a China headline is I look at CNH. CNH is China's currency during US trading hours. Now, why do I watch CNH? Because it tells me whether or not that a news headline has any sort of economic bite. And the important thing is that during the trade war, during news headlines, always watch CNH. It tells you whether or not a news headline has any sort of economic significance. And time again, CNH is telling us that these headlines around the internet companies is not economically viable. Now, we are seeing green shoots. We are seeing more transparency around the regulation, that the Chinese policymakers recognize that how this regulation has been implemented has not gone well. It has a potential to hurt China's economy because of how important these companies are to China's domestic consumption story, China's urban middle class, but it also could hurt China's economy because multinational companies might be hesitant to invest in China. That if I'm Tesla and I built that factory in Shanghai, I'm worried about what I'm seeing to the KWEB companies and saying, could that happen to me? ExxonMobil is building a multi-billion-dollar petrochemical plant in China today. They have to be worried. So we're seeing that recognized, and we're getting more transparency around this regulation. More importantly, data protection laws go into effect in September and November. That means we have a finish line. And more importantly is we're seeing from the Q2 earnings, just as we saw in Q1 and Q4, that the companies are adhering and adopted to this regulation. And how did PDD grow 89% if it's being hurt? It's because it's not. So the media has done a great disservice to this situation, and that's ultimately the value add of us at KraneShares, is providing a balanced perspective. And I've got some disclosures from our compliance perspective. At this juncture, I'd like to hand things off to Freddie.
Thank you, Brendan, for your comprehensive overview of China. Just as you mentioned, Pinduoduo, the numbers came in at 11% increases in net profits. It's smashing every estimate out there. So really, it's a matter of short-term versus long-term, and we feel your cases for being a long-term investors when it comes to China. As I'm seeing some of the Q&A, and my portion sort of relate to it. So I want to thank our attendees for the questions, in particular Ming and Chi Mun Wong's. Essentially, the questions revolve around why StashAway increased exposure to China in July. Understand it's a long-term play, but wouldn't you be more prudent to maintain a lower exposure? And then there's other questions in line of, do you evaluate political exposure? Why would you invest in China? Why don't you time it better? Right. So a bit more StashAway specific, and my quick few slides would draw the principles for you and in a way answer those questions. So let me just share those screen very quickly, and just to sort of address the elephant in the room first. Hang on. Right. Okay, present. Here I have exactly the allocations on the right-hand side of the table by portfolio risk point. I've also highlighted KraneShares being on a year-to-date basis down around 40%. So clearly it does have impact on some of StashAway's portfolio that have a higher allocations to it. So I got the questions about why don't you lower exposure? Honestly, it really is a function of the risk the user has chosen. If you belong to the high risk profile, you've chosen the high risk or the highest risk portfolio, naturally the algorithm goes on a heavier allocation. That's by design. And as you can tell in the middle row, the allocations on KWEB start going down all the way to 3% as you start going towards the right-hand side where you have lower StashAway risk indices, right? So I would address this question as in it's a function of your risk profile. When we say high risk, it really means high risk. And the higher return is sort of an average old saying that, you know, high risk, high return, that's on average, and you need time, you need reinvestments, you need to stay on a plan to realize those compounding power to get to the average high risk, high return sort of behavior, right? So I want to address the elephant in the room. It is true, it is annoying, it is part of StashAway's global portfolio. We have deliberately taken a long-term view on this, jolly well, knowing all that's happening to it, because a lot of our users, in our opinion, they're building their wealth. They're investing their monthly savings every month. You know, we can't always keep buying the high, and which sort of is sort of what I'm trying to get at in my first slide. When I start talking to myself or everybody around me, we all wanted to buy low, sell high. In reality, what happened is a lot of us end up buying high, hoping to sell higher, or because of that sort of a pressure for short-term return, we end up, you know, not making those sound long-term calls, right? So if you make a series of short-term driven investment decisions, you will never get to the long term, because what it means is greed or fear of missing out always gets you to the higher point. You're just hoping to sell higher. At some point, that's going to implode on you. And as you've seen, StashAway started in the last 4 years. Plenty of disasters to worry about. It's always another doomsday, as said by the media, right? We started in the late part of 2017, 2 trade war market corrections in 2018. Then we have COVID-19 last year, right? And I'll show you the long-term track record and line it up with the short-term later. But again, you can't, it's impossible to read Donald Trump's tweet when he was still the president. The fire and fury can come in the weekend and totally flip and flop and whipsaw everybody else. Some things are simply left, it's best left untouched. In terms of politics, I would say the same. In terms of flip-flopping and noises, I would say the same. But you got to look beyond all the noises and look at the sound fundamentals. And Brendan's done a wonderful job earlier in highlighting to you a lot of the key ingredients, right? But this is a principle here. And just highlight how well the media is doing their job and what inferences they have brought to the markets. I have here an example for you. If you just go to anything, any search engine, you search for, you know, trade war, COVID-19, China crackdown. In this case, I have in the chart the search term recession as represented on the right-hand scale, blue line. This number will oscillate between 0 to 100. So when it's 0 to 20, it's sort of an emerging interest. More and more people hear about it, but it's still a very little amount of people. And then when you see that the increases from around 20 and onward, it means that people are starting to get aware and worried, and the market start responding. And then as the media sees this, they optimize for this. And then they do very well in promoting the stories, and the biases start coming in. Such interests continue to go up. But at some point, everybody in the room, so out of 100 people in the market or the room, has already knew about this, has already heard about this, has been more than talked about. You walk to the food center, you go to the department store, you hear about it, and your wife calls you about it, your secretary calls you about it. That's when you know it's 100 out of 100. And as you can tell here, the black line, which is the market, MSCI World Equity Index, actually reversed completely to that search interest right at the extreme. And that's exactly the kind of the Goldman Sachs US-China sentiment barometer that Brendan highlighted earlier. It's exactly that kind of signal. It tells you that when you get to the cheap point down here, the fear, it is true. You wouldn't want to buy it. It's cheap for a reason. However, what it's telling you here is that if everybody in the room or in the world is talking about it, people are calling you about it, the market will actually tend to surprise. So the only way as long-term investors that we protect ourselves is to recognize our investment objectives. If I'm a saver that's very disciplined and I do my net savings every month and I deploy it in the markets, I actually would be more than happy to buy dips. The lower they go in the near term, the better it is for my long-term wealth. However, if I'm a billionaire and I invest all my billion in one place and tomorrow KWEB goes down 40%, which already did this year, yeah, I do get hurt. It is annoying. So it really depends on your financial plans. If you are building your wealth and you're deploying it in according to your plans, that's long-term, you should be happy right now. If you are a wealthy person and you have invested every single thing you have, yes, there's a legitimate concern to manage those noises more tightly, more actively. That's totally understandable. So it really depends. But majority of us, we're building wealth. We are gradually deploying to portfolios. So keeping that in mind, we as an investment committee and our algorithms, we were aligned in trying to plant the next seeds for your portfolios. And these seeds are going to be very colorful. And I want to tell you this, you don't have to be just China getting caught in something like this. Energy last year in the first half of the COVID crash was a similar situation. You could have any sectoral investments, any particular assets or country-specific stuff that could actually get caught in the near term. Well, how you make full use of it is really down to your financial plans. Long-term investors always win. That's sort of the point I'm trying to make. And that sort of philosophy is not coming from nowhere. It came from our returns. You can see here in the table, year to date, we did get affected. Like SI 30 is 5.4, SI 36, the highest risk portfolio is 1.5. Obviously, the KWEB investment did take away quite a number of percentage points in a very good year, but we are planting next seed for the future. However, the main point of this table is to show you the consistency of repeating performance when you sort of stick to your plans and you stick to something that's tried and tested through time. Over the return last 1 year, not too shabby. 2 year, pretty similar picture. 3 years, numbers start getting slightly better. The 3-year numbers versus our 4.5-year numbers since we launched in middle of 2017, is starting to tell you a common story. Whatever the noises you see day to day, the returns are increasingly consistent, regardless of how you look at it, given enough time. I kind of always look at the year to date or the 3 months or the 6 months because we're trying to plant the next seed for the future success of your portfolio. So as my favorite person in the world, he's not an investor, but he's a physicist, Albert Einstein, has always said compound interest is the 8th wonder of the world. He who understands it earns it, he who doesn't pays it. And the way to could unleash compound interest is to maintain that long-term perspective, to have a game plan before you even invest your first dollar. That consistency will come in through time. The last thing you want to do is to react to some politics or try to read it or get knocked out of it, and then the market went back up and you missed going in. I've personally been around for a while. I'm getting old, and I've seen 2008 how many people go whipsaw, and they have never got it back to the markets. People got taken out, and in 2009 March onward, when the central bank rescued the world and the quantitative easing came in, we went on a 10-year bull market. These people has never gotten back in. They didn't know how, because when you lock in the losses at 50%, and the market went back up, you just simply froze. So it is easy to look back and say, I wish I would have done this. Maybe I should have focused on the short term and all that. But really, you wouldn't know. Nobody has a crystal ball, not even Einstein, and certainly not ourselves. So I hope this addressed quite a number of questions in the Q&A, in the sense that there's a framework behind our portfolio construction. We look beyond the noises. We look at valuation, look at economic cycles. We sometimes pull out an all-weather strategy to just preserve capital. This year's whatever happens is just merely giving up a couple of percent of returns to plant the next seed for the future success of your portfolios. So really, you wind back the clock, we would do it again. So that's sort of where we stand as an investment committee, as an algorithm. And I will stop here and put the floor back to Amanda.
Thank you so much, Freddie, and thank you so much, Brendan, as well. I think it was a very comprehensive presentation where, I'm looking through the questions, and I think a lot of questions have already been covered. So what I'm going to do is try and address those questions that were not covered in both their presentations. Okay, so let's just start really quickly. So we have a question for you, Freddie. So I guess this relates to what you just said, right? For long-term investors, one would obviously typically recommend or advise to avoid timing the market, as time in the market is what matters, right? So what is your view on whether ERA is a mechanism attempting to time the market?
No, ERA is neither active or passive. There's a misperception out there. I think both passive versus active debate misses the whole point. ERA is actually saying, the passive is saying forever, I don't change. I'm always a 60-40 person, I am. That's fine too. It depends on your temperament. Because if you go through a few crashes and crises or economic cycle that's really, really down there, you don't want to make a change, that's fine, as long as you budget for it. But what ERA is trying to do is to take those leading economic information and take those valuations as well. KWEB is obviously undervalued. Gold was undervalued when we first bought it in December 2017 at 1242. I got a lot of phone calls calling me stupid back then, a new robo on the block. Buying gold when emerging market was up 44%, US technology was up 41%, roughly there. But the thing is, that was the second most undervalued situation ever for gold versus the economic cycle. And we sort of, and then it has a lot of value for creating protective value for portfolios, right? So the same thing as in KWEB right now, as Brendan's highlighted, forward P at 16.9 times, really low. PEG forward at 0.8 versus US at 2.5. I mean, when do you get an opportunity to buy something with a wonderful long-term potential at such multiples? You don't. If you don't buy now, you just end up buying the high all the time. I don't know, Amanda, I probably digress a bit, but the stance is the same. We look at valuation. We look at where we are in the economic cycle using leading indicators, and we combine the two, we try to harness it, but it's not going to work magic in terms of a 5% surprise drawdown, a 10-15% surprise drawdown that temporarily and goes back very quickly. That's not the stuff that we are concerned with. We are here to build long-term wealth. That's what StashAway's mission statement is. And as a result, the investment algorithm is built for that. We can actually turn up the engine to be an active trading platform too. As you all know, I was an active fund manager myself. ERAAs, but we can basically narrow its threshold and it will start trading. So we designed it for long-term wealth accumulation, building, and protecting them. So giving up some return this year to go into something with a phenomenal long-term potential. I think Brendan has a lot to say here. I felt like it's a small price to pay. Again, like I said, wind back the clock in February and March, we'll do it again.
Thank you so much, Freddie. I think you definitely answered that question as well. So the next question that I have is for Brendan. So we have, Brendan, someone asking, at what juncture would KWEB start transferring ADR to Hong Kong shares? And then also, you mentioned that only around half of it will be converted fully. So what happens to the remaining half?
Yeah. So today, about 2/3 of KWEB is in US listed companies. A third is in Hong Kong listed companies like Tencent, Meituan, Kuashu, and others. Of the 2/3, the 60% that is in US names, half of those names are listed in Hong Kong today, are duly listed. So you've got Alibaba, JD, NetEase, Baozun, Baidu, Autohome, Bilibili, Trip.com. And it's our expectation that you'll continue to see more of these companies relist in Hong Kong. NEO and XPeng already relisted in Hong Kong, but NEO and Li Auto filed for a Hong Kong listing about 2-3 weeks ago. So it's our anticipation that all of the companies will migrate. If you look at the KWEB holdings today, our very last holding is Alibaba Hong Kong, that we converted a few hundred shares of Alibaba US to Hong Kong. Again, that's a very easy process. You simply tell your custodian, and at the end of the US trading day and the next day you have the Hong Kong. So we did a test conversion. It's really about our monitoring of the enforcement of the HFCAA that will drive that decision. That we speak to a number of political research firms, industry groups, lobbyists in Washington, D.C. on a weekly basis, because, you know, again, as stewards of capital, as fiduciaries, we have an obligation. We are legally obligated to protect our client assets, and we will act always in the best interest of our shareholders. And I have a I own a fair amount of KWEB. I own a lot of our ETFs. It's a very significant position personally, and you know, you just have my word that if we anticipate a strict enforcement of the HFCAA, we will exit the US names for the Hong Kong listings. For the names that don't currently have a listing, it's our anticipation that over the next year, all of KWEB will be convertible. That Hong Kong is in a process of changing their listing requirements to allow all of the companies to relist. That they call it a consultation. That consultation on eliminating the rules that prevent all of the companies from relisting, we know will go away. That is anticipated probably over the next few weeks that we'll get the new rules, and that will lead to a flurry of IPOs as all of the names. So we think that on the HFCAA, the important thing is we don't know when that 3-year clock starts. There's arguments for why it couldn't start next year, but once, you know, that will give a strong impetus for us to start the process. Now, last Friday, the CSRC, which is China's financial regulator, put out a public statement that they would like to put this issue to bed. A very strong statement from the CSRC where they said that this issue has been out there since really back to 2012, 2013. They want to see this issue resolved. And there's really, all of the companies in KWEB are audited by the big 4 US accounting firms. And again, those same auditors do US listed companies, China operations audit. So the issue has been politically sized, which is a shame. But why would a politician want to hurt US investors? There's $2 trillion of US savings in those companies that we hold in KWEB. So we think hopefully cooler heads prevail, but we have a strategy in place that will be implemented if we see a strong enforcement coming. We will act.
Thank you, Brendan. And I think, Freddie, I think it'd be good to also get your perspective, because we had a question that was sent in saying that, BlackRock, Vanguard, State Street switching out of ADRs into Hong Kong listed shares. So what is StashAway's viewpoint on that, on sticking with ADRs when there are H-share ETFs as well?
Well, first of all, the principle is not to overreact, but to dissect the situation. And ADR or not, there's a 3-year clock, and the clock has to be initiated on specific companies. Like you declare that you accept supervision, and if you fail certain standards, you have 3 years to rectify with the US regulators. So the clock will start when you get a notice, but it doesn't mean you're delisted. You can still work towards complying. So it's a very far thing. This 3 years is not just sitting there and waiting for 3 years. There's a lot of processes before you get there. It's a bit like a lot of hurdle rates. You have to get there. And two, I'm actually thinking delisting risk is less in the US than the other way around from the China side. And we also analyze that. The so-called use of the VIE by almost every companies out there. Like most of us know that, in Chinese law, actually none of the Chinese companies, most of them have never been legally allowed to be owned by foreigners. Did any one of you know that? The VIE, the variable interest entity, resolved that because it's a company that is set up in, say, the Cayman, exactly Cayman most of the time. And that company has a contractual arrangement to own all economic interests and profits of the China company. And that company will go to the US, work with a bank, and issue the ADR. So that's how the whole mechanics of ADR market came about. And however, what would China do with VIE? They're not going to ban it. The DD's case was entirely different. They told DD not to go ahead. It was not approved. They couldn't even stop DD legally because the jurisdiction is outside China. And DD went ahead and disrespectfully did so at a timing of the 100th year of the anniversary of the Chinese Communist Party. What do you expect that to happen? So there's a lot of bad behavior that needs to be addressed. And so the VIE situation is going to be China for the first time want to have a say about who gets to issue a VIE and go IPO this way. They want to also tell you where you should go IPO. You may not be allowed to go to the US. There's plenty of capital at home or in Hong Kong, but China wants to have a say. Why? Some companies have so much data be in a crosshair between the US-China warfare, and you start being stuck in between national security from a Chinese perspective or the US subpoenaing for data. So this is actually organized way, and for the first time, VIE is going to be approved by the regulator. It has never been approved. It was all illegal. They're just trying to make it legal. So it's actually better for the whole market, as long as Brandon and team is ready to go to Hong Kong or stay in the ADR market. As long as we have the flexibility between the two, the choice between greater liquidity in the ADR market or going to Hong Kong just to remove that risk, as long as Brandon and team is on top of that, that's no issue.
Yeah, and I definitely 100% Freddie. And one thing about why did BlackRock move? Well, MSCI and FTSE indices consider their index methodology says that the US ADR is a foreign listing and the Hong Kong listing is a local listing. So after their index methodology say that after 1 year, if the Hong Kong listing has 30% of the value traded when compared to the emerging market index, they convert. So Alibaba, because they relisted in Hong Kong in November of 2019, it was the first company that met that 1 year rule. So MSCI has two semi-annual index rebalances, June 1st and December 1st. So on the June 1st rebalance, they did this conversion to Alibaba Hong Kong. On December 1st of this year, it's very likely JD, NetEase, Yum China, and Baozun will be converted in MSCI indices to the Hong Kong share class. And to Freddie's point, Why we haven't moved is because the US names have significantly more liquidity and significantly lower trading costs. So over the last 20 trading days, the value of trading in Alibaba US was $5.3 billion, but Hong Kong was 765 million. So as much as Alibaba Hong Kong trades, it's a fraction of the Hong Kong. Now, the other cost for investors is bid-ask spread. So the bid-ask spread on Alibaba Hong Kong is 7 basis points versus 2 basis points here in the United States. So it's because Hong Kong has a stamp tax, which was on August 1st increased to 13 basis points. There's no stamp tax in the US. We've not converted simply because there's a much higher cost to transact. And again, as a fiduciary, we have to balance liquidity, transaction costs. It's just a simple fact that it's more costly to trade in Hong Kong. At the same time, I do believe that volume in Hong Kong will increase over time and that there'll be this movement. And that's really highlighted by, after the Hong Kong close yesterday, JD.com reported earnings. And the US share class of JD.com went up. I just want to get the exact number for you. Yesterday in the US, JD went up 3.3%. Today in Hong Kong, JD went up almost 15%. So given the exact same piece of news, the US went up 3% and Hong Kong went up 15%. Now those shares are convertible, so we expect JD to go up a lot in the US today. So I think it just shows that the US market, the media plays such a disproportionate percentage of influence that historically, it's been talked about American optimism and exceptionalism. But today you have American pessimism, that's something that I'm not proud to say as an American. But Americans have gotten really pessimistic that we have undue influence by the media, and in finance, everything we do, Freddie and I, is data driven. It's about the facts, and unfortunately, when it comes to a lot of things in the media, it's not data driven. The news headlines on JD's results yesterday in the US were all about, well, despite regulation, JD beat earnings. And in Asia, investors said, JD did absolutely fantastic. And I think it's something that, it kind of worries me as an American. At the same time, there's a validation about our thesis and as investors being data driven, and it gives me a lot of comfort to see the reaction in Hong Kong and in JD overnight.
Great, thank you so much. I believe that answers that question. And I'm noticing also that we are running out of time, going way past the hour. So maybe what we can do is, Freddie, Brandon, I think what would be good is if you can just give everyone this evening, one thing to keep in mind as one key takeaway, I guess, from this session today. What would you want them to kind of know or leave this webinar kind of knowing?
Oh, sorry, just one of our institutional brokers was, we talked to our brokers, and a lot of them are, very excited about what's happening with KWEB. That it looks like it's going to be a monster day. Ultimately, I believe that the companies in KWEB are simply the very best companies in China today. They are the transmission engine for domestic consumption in China. the Brookings Institute did a report saying that China's urban middle class generates $7 trillion of spending, and that flows through the companies in KWEB. And I think ultimately, these companies, because they play such a pivotal role, should be regulated. It's really been about the implementation of regulation that has been disconcerting to investors. I'm very much a believer in KWEB. As an investor myself, being invested in KWEB personally, I'm in this for the long haul. And Freddie touched on the long-term perspective, and one of the things that in earlier this year, I read Berkshire Hathaway's annual report, their shareholder letter. And in that letter, you'll notice that they own the Chinese electric bus maker, BYD. They bought BYD back in 2009. They invested about $200 million. And right after they bought BYD, the stock doubled, and then it gave back all of its gains. And for 9 years, BYD did nothing. It literally didn't move. And all of a sudden last year, the world woke up to what BYD's been doing, that this is one of the most important companies in the EV space. And Berkshire Hathaway's $200 million investment rose to a value of about $5 billion US. But the lesson that I took away is, for 9 years, Warren Buffett and Berkshire Hathaway, Charlie Munger, owned a stock that didn't move, but they had conviction in their thesis. And it took the market a long time to come around to their way of thinking. But think about 9 years they held a stock that didn't move. The resiliency, the confidence in their decision. I think that's a really important lesson for all investors, that the markets sometimes don't validate our thesis on a daily basis. But we know personally, it's my belief that the KWEB companies are the best companies in China. And, in 2009, 2020, we had a very strong return. And I do believe that we have better days ahead of us. I wish I had a crystal ball and I could guarantee that. Unfortunately, I can't. But I've never been a bigger believer in our thesis. And I'm summoning my inner Warren Buffett and Charlie Munger to stick with this trade. And I certainly appreciate this opportunity to provide our views, and certainly appreciate Freddie and Amanda and the broader StashAway team, your conviction, because the fundamentals have never been better for KWEB. It's simply the price action. And I think in the long run, our thesis will be justified by the price action.
Well, my opinion is certainly it's not going to take 9 years for KWEB to do well. By the way, guys, in this channel, KWEB is one of the very few ETFs that's so impactful in the market that they have an options market trading deeply on the value of KWEB. And the options market, if I have to interpret it, things that KWEB, you look at the volatility, the information price into the options markets, it says that KWEB will do very well in 6 months' time. Of course, I wouldn't know that. It's what the options market is saying. Jokes aside, look, the main point I want to make is, guys, don't forget that the KWEB names or the Chinese tech giants that we have, they're kingmakers in this ecosystem. There's nothing to stop them from pivoting. You can already tell from Tencent, the recent news on Tencent, they have stealthily and quietly built up a giant enterprise solutions platform. It just came up. Nobody even knew it. These guys have a lot of resources, a lot of money, a lot of gunpowder to pivot. What the Chinese government is trying to do is to set in the right social impact, the right social direction, and these companies can essentially pivot in the right directions. There's no doubt about that. There's nothing to stop Alibaba from being invested more AI and robotics. If they want to make their own chips, they can if they want to. So I'm not going to speculate here, but what I'm saying is don't forget, these are kingmakers. They can pivot. And number two, the Chinese government does have a PR problem. I acknowledge that. It's like somebody up top thinks we should have more common prosperity, and every different agencies are now eager to show that they're doing something about it. So you see an onslaught of sort of a measure from different places, and it scares you. I assure you it's not as coordinated as you think these days. It's really how commands are being handled. And is the market feedback loop is now the information is now back to the government's hand. They do care about the markets. They do care about employment. They do care about what the market can do to the economy. Delta Plus is spreading. The economic numbers have softened a bit. It's still firm. They need to do something soon. So look, there's a feedback loop that's very different from the way Western society or markets work. In China, is a whole different animal. I have never seen such a more exciting time to plant the next seed for the future. So I will leave you with 3 bullet points. Yes, China has a PR problem. 2, the names we invested in, they are kingmakers and they can easily pivot to the right direction that aligns with the government. 3, there's no better time to plant the next seed for your portfolios.
Great. Thank you so much, Freddie and Brendan. I think this was a super informative session and a very long session as well. So thank you all so much for sticking with us. I hope it was helpful and actionable as well. You were able to get some tips for your own portfolios and how you should go about thinking about it. So I'll take this as, I just wanted to thank everyone again and kind of wrap it up. Thank you, Brendan. Thank you, Freddie, for taking time out to join us today. We really, really appreciate your insights. And have a great rest of your evening, everyone.
Thank you so much. Thank you, Amanda. Thank you, Freddie.
Thank you.